The signs are everywhere, but most people are too busy watching stock prices instead of the indicators that actually matter to those stock prices. In the next few minutes, I'm going to show you the charts that the mainstream probably won't show you, because if they did, it could spark a broader sell-off. We're not just talking about a regular market downturn, we're on a path that we've actually already traveled before, and it didn't end well. No one can say for sure, but multiple key indicators are pointing that there's a lot of downside to come. We examine everything from the yield curve to the CAPE ratio to gain a sense of where we are and where we might be headed next. First up is what some people believe to be the best recession indicator of all time. That is the yield curve inverting and then uninverting, which has historically been a nearly perfect recession indicator. With the yield curve snapping back to normal in 2024, many investors are basically bracing for a recession to begin in 2025. Even the Fed has increased their forecast for a recession. This is definitely something that you'd want to keep an eye on. Next is the auto loan market, which has rising delinquencies and declining sales. The auto loan sector has been exhibiting extreme and significant stress as the number of delinquent loans, 90 days or more, continues to grow and surpasses their long-term average. Wilbert Vanderklaw, an economic research advisor at the New York Fed, noted that, quote, high auto loan delinquency rates are broad-based across credit scores and income levels. Whenever consumers struggle to meet their debt obligations, it usually reflects underlying financial instability that can lead to reduced consumer spending, and of course, that could lead to a recession. Let's talk about mortgage delinquencies, which are also a growing concern. It's not just auto loans, but also mortgage delinquencies that are on the rise as well. The national mortgage delinquency rate continues to increase back towards their 2022 levels. This trend underscores vulnerabilities that are happening both in the residential and the commercial real estate markets. Freddie Mac reported that single-family delinquency rates increased from 0.59% in December to 0.61% in January, and that their multifamily delinquency rate increased from 0.4% in December to 0.42% in January. Multifamily loans, which are frequently adjustable rate loans, usually react faster and first to rate hikes. But we still need to wait and see what happens to single-family loans, which of course after the 2008 crisis are usually on a fixed rate. And according to the Mortgage Bankers Association, the seasonally adjusted mortgage delinquency rate increased for all loans outstanding in the last quarter of 2024. Quote, by Sage, the 30-day delinquency rate decreased 9 basis points to 2%. The 60-day delinquency rate increased 3 basis points to 0.76%, and the 90-day delinquency bucket increased 11 basis points to 1.19%. More economic pain could come from the already weakening housing market as more single-family loan maturities come due. Now let's talk about corporate bankruptcies and layoffs, which is of course another alarming trend. Corporate bankruptcies have surged, reaching a 14-year high in 2024, with 694 public and private companies filing for bankruptcy. This surpasses the previous peak during the pandemic in 2020. And reflects mounting financial pressure on businesses. The increase in bankruptcies often correlates with rising layoffs, further exacerbating economic concerns. This trend could only get worse, and there's a wall of maturity to climb ahead, assuming that rates don't change in the meantime. For more in-depth analysis of the corporate debt maturities and the wall that's coming and that potential impact on the economy, you can check out our 2025 Gold Outlook report, which is in the link in our description. Now let's talk about falling oil prices, another key indicator reflecting potentially global economic woes. First, oil prices have plummeted to their lowest level since 2021, with West Texas crude oil futures hitting a session low of $58.95 per barrel. Generally, falling oil prices can indicate weakening consumer demand and an economic slowdown that are often a leading sign towards a recession. Such a big drop and a sudden drop in oil prices often signals concern about reducing global demand and of course economic slowdown. Now let's talk about something that you might not have seen, which is the growing high yield spread, which is a rising credit risk. The ICE Bank of America US high yield index option adjusted spread widened to 4.01% in April of 2025. An increasing spread between high yield or junk bonds and treasuries that reflects heightened and perceived credit risk happening in the market. This widening indicates that investors are demanding demanding more compensation for taking on more risk, which is usually a precursor to tighter financial conditions and, of course, potential defaults. While the indicator isn't screening a recession yet, it certainly bears close monitoring. Now let's talk a very interesting one, which you might not know, of the CAPE ratio. So this is by Robert Shiller, who demonstrated using 130 years of back-tested data that returns of the S&P 500 over the next 20 years are strongly inversely correlated with the CAPE ratio at any given time. In other words, the CAPE ratio, which is the cyclically adjusted price to earnings ratio, or CAPE, of the market is high, and that means stocks are overvalued and returns over the next 20 years are likely to actually be pretty poor. In contrast, whenever that ratio is low, it means that stocks are usually undervalued and returns over the next 20 years likely will be pretty good. Now, the CAPE ratio currently for the S&P 500 as of April 6 in 2025 was nearly 33. While this represents a slight decrease from previous months, it remains significantly above historical averages. Elevated CAPE ratios suggest that the stock market may be overvalued, potentially indicating a lot more room down if the current market corrections continue in full force. Now everyone's big question: what about gold and silver prices? We have clients asking us all the time, what do you think about gold and silver prices? Gold prices are hitting new all-time highs practically every single day. So what do we think is going to happen with gold prices? Well, first of all, lots of people turn to gold when there's lots of economic uncertainty as a safe haven asset. So how has gold performed in the 21st century as a safe haven asset compared to something like the stock market? Well, this chart compares the performance of the S&P 500 in red, the Dow Jones in blue, gold of course in gold, and silver in silver. So what about the first quarter of 2025? Well, gold smoked the competition. Gold was one of the best performing assets in the first quarter of 2025 and held its own against this entire broader market sell-off. And not only it held its own, but continues to make all-time highs, making an all-time high today in April. Regular readers of monetary metals will know that for us, gold hitting all-time highs is synonymous with the dollar hitting an all-time low. The resilience and the ascent of gold in this high interest rate environment is remarkable. And of course, it's also consistent with what we described in our 2025 Gold Outlook report. Again, it's going to be in the link in our description here. Though even we are a bit surprised by how perfect of a picture is playing out for gold. In conclusion, a confluence of economic indicators are pointing to potential further declines in the stock market, and of course, gold is showing once again why it is a perfect safe haven asset in times like today. So if you want to learn more about why we think gold is once again proving itself to be a financial anchor in today's economic storm, click the link in the description to get our 2025 Gold Outlook report, and we'll continue to keep you updated on the indicators that we're watching.